In this video, we will break down what a dealing range is. We'll define the conditions for a high probability execution of this tool and understand how to work with it. A dealing range is an unbalanced and often inefficient element in the market that can be identified using just two key points, the minimum and maximum price. If we look at this schematic drawing through the lens of volume using Japanese candlesticks, we can understand several interesting details. In the context of selling volume dominance, the price drops, for example, from $20 to $10, forming the minimum price. Here, we're not considering the market context, so for reasons unknown to us, buying volume enters at this point, pushing the price upwards. At the $50 mark, selling volume enters the market, absorbing the previous buying volume and forming the maximum price. Notice that as a result of this movement, a fractal low is first formed, which determines the minimum price, followed by a fractal high that defines the maximum price. Only with their help can we understand where those two key points of the range are located. If we consider the market context, it is highly likely that these fractals form within certain zones of interest, such as liquidity or inefficiency areas, from which the price reacts and reverses in the opposite direction. We will discuss this in more detail later on. In the end, the basic definition of a dealing range is always two opposing fractal points between which a certain movement has occurred, regardless of the price direction. For those unfamiliar with the terms fractal low and high, I'll quickly explain. A fractal low is a pattern where the low of the second candle is lower than the lows of the first and third candles. A fractal high, on the other hand, is the opposite three-candle pattern, where the middle candle has the highest high compared to the adjacent candles. To make everything clearer, let's analyze a few examples from real charts. Here's a simple example on the 4-hour chart. First, a fractal low forms, which will be our minimum price, followed by a fractal high that indicates the maximum price. The distance between these 2 points will be considered our dealing range. The price corrects within this range, then reacts and moves further upward. Another example is on the daily time frame. On the chart, there is a maximum and minimum price represented by fractals. The distance from one point to the other is the dealing range. Once again, the price reacts within this element and reverses in the opposite direction. This is basic information to help you understand how to work with this concept on a chart and avoid unnecessary mistakes. However, it's not always that simple, because sometimes all the conditions align, but the price still doesn't react and breaks through the entire range, as in this example. To avoid such situations, we move on to the most interesting part of this video, setting the conditions for a high probability execution of the dealing range. The first thing to understand is what a high resistance fractal point, or fractal high and low, is. This is a market element that describes a movement interacting with a specific zone of interest, resulting in confirmed buying or selling volume. The invalidation point of such a movement is considered the fractal low in a bullish scenario, and the fractal high in a bearish scenario, which we refer to as high resistance. The logic here is straightforward, and is based on the idea that any fractal on any time frame represents areas on the chart where the balance between buyers and sellers has shifted, indicating the beginning of dominance by one side. This is especially significant when it occurs in the context of certain zones of interest. Thus, not only can the liquidity beyond the fractal reverse the price, but the fractal zone itself can provide buying or selling volume when the price approaches it again. Let's take a closer look at the criteria we should use for accurately identifying this element. The first thing to focus on is the fractal point that forms in the context of a rebalancing fair value gap, or a liquidity raid from older lows or highs. If you're wondering why we are particularly interested in these zones and not considering rejection blocks or order blocks, the reason is that these areas can inject the most liquidity into the market. This means the price is expected to receive an impulsive reaction. The second criterion is the confirmation of volume through the formation of variables such as an order block, rejection block, or fair value gap, either on the same time frame as the zone itself or on a lower time frame. With these well-defined criteria and relying on statistical data, we can assert that upon retesting, the price is more likely to react and reverse in the opposite direction before reaching the invalidation point. This is the essence of the term high resistance. Some might say that I've simply renamed the term high resistance liquidity, and that it's essentially the same concept. However, I personally believe that this term is incorrect from a logical standpoint, and those who use it don't fully understand what they're talking about. Let me explain why. Liquidity in itself either exists or it doesn't. We cannot identify any characteristics that would indicate its resistance. We can only speculate on where it might be located on the chart. Therefore, resistance is a characteristic inherent to specific elements that meet certain criteria and have statistically validated performance, as I've just demonstrated. I hope you've formed a complete picture in your mind and understood that this logic underpins all the variables we use. So, let's move on to the final part, where we will combine all the previously mentioned information into a single tool called the High Resistance Dealing Range. Schematically, this concept involves the same two opposing fractal points, but here we focus on the zones in the context of which they formed, and the confirmation of volume from one side or the other. Let's consider a bullish scenario. The first movement of interest is the rebalancing of a fair value gap, or a liquidity raid, from which the price ideally should receive an aggressive, impulsive reaction as the initial indicator that significant buying volume has entered the market. To confirm that this low is indeed high resistance, we need volume confirmation. As discussed earlier, this is done through the formation of an order block, rejection block, or fair value gap on the same time frame as the zone itself, or on a lower time frame. For example, if the initial zone is on the 4-hour chart, the volume confirmation should also be on the 4-hour chart or on the 1-hour chart. I hope this is clear and that you've already grasped this concept well. Regarding the second zone, which acts as the trouble area from where selling volume enters, forming the final boundaries of the range or the maximum price, it can be a liquidity zone or an inefficiency zone. This could be an order block, rejection block, fair value gap, or fractal high. It doesn't really matter. Most often, the time frame on which you receive volume confirmation relative to the zone of interest will also be the time frame for your trouble area. This may sound confusing, but we'll discuss it in detail when we look at real chart examples. Another important factor that will make the dealing range and high resistance dealing range clearer and help more accurately predict price behavior is the division into premium and discount zones. Discount zone. This is the lower part of the dealing range, where the price is considered more attractive for buying. Traders look for long entry opportunities here, as the price may be undervalued relative to the current range. Premium zone. This is the upper part of the dealing range, where the price is considered less attractive for buying but more suitable for selling. Traders look for short entry opportunities here, as the price may be overvalued relative to the current range. 0.5 level. This level is often considered the balance point between the premium and discount zones. Depending on how the price behaves relative to this level, traders can assess whether the price is in a favorable area for buying or selling. It's important to note that the placement of these zones does not change depending on the direction. To make everything clearer, let's set up Fibonacci levels and then look at real examples. In TradingView, in the upper left corner, there's a tool called Fib Retracement. If you click on it and then stretch it somewhere on the chart, by default it should look like this. Immediately go to the settings and uncheck all boxes except 0, 1 and 0.5. The rest of the parameters are up to you, but if anyone's interested, here are my personal settings. The second thing that might be useful, especially for beginners, is the fractals indicator. Go to the Indicators tab and enter this name, WIC-ED Fractals. Clicking on it should automatically apply it without the need for additional configuration. The first formula looks as follows. Variable 1 zone of interest equal to variable 2, volume confirmation equal to variable 3 trouble area. This means that if the zone of interest is, for example, on the 4-hour chart, then the volume confirmation and trouble area will also be on the 4-hour chart. Here's a situation that occurred on the daily time frame relatively recently. We can see that in the context of an upward movement, the price conducted a liquidity raid of the fractal minimum that formed due to the influx of buying volume from a fair value gap. We received volume confirmation in the form of 2 order block zones, and now this particular fractal minimum will be considered high resistance. Essentially, the first 2 conditions are met, and we can assume that the price is more likely to get a reaction upon retesting. In order to clearly determine where our high resistance dealing range ends, we need to wait for the formation of a fractal maximum. As you can observe, this happens after testing the bearish fair value gap zone on the daily time frame, from where selling volume enters. We draw Fibonacci levels from the fractal minimum to the fractal maximum, and consequently obtain the premium and discount zones, as well as the 0.5 level in the middle, which the price subsequently tests along with the upper order block. The FVG in the premium zone played an important role here, as the candle couldn't close below its lower boundary. As you can observe, the delivery was all the way to the fractal maximum, which acted as the trouble area for the new high-resistance dealing range. The same formation logic applies. Testing of the bullish FVG, volume confirmation through the order block variable. We stretch the Fibonacci levels from the minimum to the maximum and get the execution of this tool. Bullish scenario, a standard situation. On the 4-hour chart, the price takes out liquidity from two previous fractal lows, after which it confirms volume in the form of an order block zone. It can also be noticed that simultaneously with the formation of the fractal high, the volume is confirmed in the form of an FVG zone. The trouble area was also a 4-hour fractal high that was formed earlier. All conditions are met, and we can stretch Fibonacci levels from the low to the high, obtaining a high resistance dealing range. The price corrects to discount values, tests the order block zone, and receives an impulsive reaction with further delivery. This is already a bearish scenario where the first variable is a fair value gap. The second variable is volume confirmation, which can actually be taken as a rejection block, an order block, or an FVG zone. The third variable was in the form of a daily fractal minimum, from which the price received buying volume and formed the minimum price of this range. Despite the fact that the movement continued essentially after testing the 0.5 level, I want to draw your attention to an important point. When using this approach, the price is often already deep inside the range when the fractal minimum or maximum is confirmed, as this example clearly demonstrates. Therefore, there's a small life hack, or you could say a rule that states, if in the context of a reaction from the trouble area, the price receives buying or selling volume, and we see a rejection or opposite candle, but there's still a lot of time before the formation of a fractal maximum or minimum, we can move to one time frame lower to determine the range boundaries. This will significantly speed up the process and provide an opportunity to not miss interesting positions. Let's return to our example. In the context of a fractal minimum acting as a trouble zone, the price begins to form a green upward candle. This is an indicator that buying volume has entered the market. To avoid waiting for another candle, confirming the minimum price, we can switch to the 4-hour time frame, where the high resistance dealing range from the daily time frame will look approximately like this. From this, we can make another note. According to the basic logic, any dealing range is, first and foremost, two opposite fractal points. Consequently, these fractal points don't necessarily have to be the first two, although this would be considered the ideal case. As I mentioned earlier, for more accurate identification, it's equally important to consider the context or zones in which these fractals are formed. Personally, I see 4 high-resistance dealing ranges here. Here's the first, second, third, and even this one will be considered a high-resistance dealing range on the 4-hour time frame, regardless of the fact that it coincides with the range on the daily time frame. The next formula can elaborate on this idea in more detail, and it also embodies the validation of the idea through obtaining volume confirmation on a time frame lower than the zone of interest. We discussed this in the previous video. The formula is as follows. Variable 1, zone of interest greater than variable 2, volume confirmation equal to variable 3 trouble area. Here, if the zone of interest is, for example, on the 4-hour chart, then the volume confirmation and trouble area will be on the time frame below, namely on the 1-hour chart. In our first example, we consider a daily fair value gap as the primary zone of interest, where we need to obtain volume confirmation. Shifting to the 4-hour time frame, we observe the price testing this zone, followed by the formation of a rejection block, signaling an influx of selling volume. We also identify an order block as the support level breaks. Upon reaching the FVG on the 4-hour chart, the price halts and forms a second candle, establishing the minimum price. This scenario qualifies as a high-resistance dealing range under our second formula. It's noteworthy that this movement also creates a bearish fair value gap, from which the price later resumes its movement. Here's a similar example, but using a bullish fair value gap. On the 4-hour chart, the price rebalances this inefficiency, taking out liquidity from the fractal minimum, after which aggressive buying volume enters the market. an impulsive upward movement occurs, and the volume is confirmed in all three ways, indicating the acquisition of a high-resistance fractal low. Since the left side of the chart is located quite far away, we don't see what caused the price reaction. As a result, we get two fractal maximums that form the final boundary of the range. Logically, both the first and the second can serve as an anchor point for Fibonacci levels, and this would not be a mistake at all. Ultimately, if we were to make a brief conclusion, the first formula is more suitable for understanding the context and direction of price, while the second formula is better for identifying and providing additional confirmation of the variable that validates a specific zone of interest. But we haven't yet discussed the formation of a dealing range from zones such as order block or rejection block, which obviously occurs frequently on the chart. Personally, I don't categorize them as high resistance, even if they confirm volume, and there are two main reasons for this. The first reason is that order block and rejection block don't provide as much liquidity to the market as a fair value gap or fractal minimums and maximums do. The second reason is quite interesting and lies in the formation of a liquidity pool in some cases after testing one of these two variables. In other words, this is also called equal lows or highs, which can serve as price targets. Thus, when approaching again, there is a higher probability of raiding these zones, but this by no means implies that these dealing ranges cannot provide volume for buying or selling. That would be an erroneous statement. Therefore, let's look at several examples of successful execution in such a context. On the daily chart, there is an order block zone that formed due to a liquidity raid from an older fractal high. Here we will use the second formula, so we move to the 4-hour time frame and see that after the test, the price, although not actively, still formed a high resistance dealing range within a bullish rejection block. Note that even if the main zone of interest is the daily order block, on the 4-hour time frame, the price still received a reaction from the fair value gap. If we go even lower, to the 1-hour time frame, the range doesn't look attractive, but it still fulfilled its function, primarily thanks to the fractal that provided liquidity to the market, and the price continued its movement. We'll talk about this in other videos because it's quite a complex topic and needs a lot of attention. In the second example, we will consider the first formula, and here we see that a rejection block formed due to the rebalancing of the FVG on the same time frame, which is 4 hours. Then this zone is tested and confirmed by volume, which gives us the right to consider this rejection block valid. The maximum price, or fractal maximum in turn, is formed again in the context of testing the rejection block. We get a fairly corrective movement almost to the very point of invalidation, but the price doesn't reach it and continues along the trend. Here it's more clearly visible what I meant when I said that the price forms a liquidity pool, which will be more attractive in the future. To avoid prolonging this video, let's discuss the final topic: how to determine how deeply the price will retrace within the range. We'll talk about this in more detail in the next video dedicated to the topic of order flow. But here's what you should remember now. There are two main indicators by which you can determine that the price will receive a strong reaction in the context of the trouble area, which will lead to a deep retracement, or even, in some cases, to invalidation, regardless of whether it's a high-resistance dealing range or a simple dealing range. The first indicator, or we can say an additional formula, is when the price confirms volume after testing the trouble area. The trouble area is the same zone of interest, just oriented against us or our range. The basic zone validation formula applies here. Variable 1, zone of interest greater than or equal to variable 2, volume confirmation. Only instead of zone of interest, it will be trouble area. It's simple. As a result, it turns out that a dealing range or high resistance dealing range is a deep retracement, where variable 1 trouble area is equal to or greater than variable 2 volume confirmation. Schematically, it looks as follows. Accordingly, we can assume that in the context of volume confirmation, the price is more likely to correct more deeply. The second indicator is when the trouble area is on a time frame higher than the time frame of the current range. What does this mean? For example, if your range is on the 4-hour chart and falls into a liquidity zone on the weekly or daily time frame, then the price has a higher probability of a deep correction, or even a complete invalidation of your range, regardless of whether it is high resistance or not. I hope this video has been helpful, and that I've successfully conveyed my understanding of this tool. A dealing range can often appear in various forms, sometimes less visually appealing. Nevertheless, It's a valuable aid in comprehending market context and can either support or challenge your theories about future price movements. But it is more abstract, despite the fact that I tried to formulate certain formulas as accurately as possible. It is much more important to pay attention to the forming variables. In conclusion, I want to say, don't forget to like, subscribe to the channel, and leave a comment.